Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Joe Ruscio of Heavybit. Heavybit is a venture fund that invests in developer-first startups. A lot of their companies make products used by software and technology developers. Very interesting niche. In this episode, we talk about what's happening in the software developer tools market, how AI is changing the game, why AI is like having a weird intern on your team, how VC is evolving, good and bad reasons to raise capital, and much more. If you're tuning into this podcast, learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup, or Fundingstack.com if you're a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Joe.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
3, 2, 1. Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and Fundingstack.com. Today I have Joe Ruscio of Heavybit coming to us from Portland. How's your day going?
Yeah, it's going great. Excited to be here.
Good. Let's get right to it. What's Heavybit?
Yeah, Heavybit is a early stage venture firm based in San Francisco. Me being up in Portland notwithstanding, but with a deep vertical focus on infrastructure software. And so that means like the products and platforms used by technical practitioners to build, operate, secure, maintain software, design, analyze. So anything, if you are in a company that's building or running software, which in the 21st century means any meaningful company, you're invariably going to be using a number of our portfolio companies' products. We're based, like I said, in the Bay Area, but we're geo-agnostic. We invest in companies across North America, Europe, Israel, India, etc. Early stage, that means pre-seed, seed, primarily.
What's the backstory? Were you a software engineer and you realize there's a ton of opportunity in the space, or something else? What's the path?
Yeah. I mean, my backstory in the firms, I've been an investor at the firm for about 6.5 years now. Prior to that, like I said, our backstories are sort of intertwined. Prior to that, I spent about the better part of 20 years as a software engineer turned computer science PhD dropout turned serial, a founding CTO, CEO, as one does. And so along the way, all the startups I worked on were in some kind of distributed systems infrastructure or another. I worked in high performance computing and data center orchestration, automation, and finally, my last startup, I was just obsessed about cloud computing in 2008-9, and founded one of the very first cloud native infrastructure monitoring and observability companies. It's a company called Librado, and that was about the same time I was doing that. Two of my partners over at Heavybit, and my now partners at Heavybit, had this shared vision. They similarly came from a software engineering background, and I think importantly, it was the notion that for me, continuous delivery practices and then ephemeral computing like cloud computing came together to remove basically prior to that, the bottleneck to getting a business requirement turned into running code was something like procurement of servers or approval of some like static review committee. But now, and we've been now operating for pushing 2 decades now in an environment where the bottleneck is how fast can your developers move. And so when Heavybit was founded, it was very, very kind of early in that change, and realizing that how fast can your developers move is the single most important question for almost any business. And products that help your developers move faster and get more leverage and productivity are going to be invaluable across the entire economy, and will be like $1 trillion category. I think that was fairly contrarian when they founded the firm, and much less contrarian today.
Yeah, it's interesting. Products that help your engineers go faster. I am not the technical guy in this business, so I only recognize a couple of the names on your portfolio list, like PagerDuty. I get that
right.
one.
Yep. Public company, that one sticks out, sure. Yeah, PagerDuty, Circle CI, which for testing, or Sneak for DevSecOps, Netlify for hosting, Tailscale for Mesh VPN, newer entrants like LocalStack for emulated developer environments. So everywhere from generating code to testing it to shipping it out to production to securing it and running it. That's kind of our broad purview.
Yeah, good. Yeah, I know you use Circle CI. I know I recognize a few of these names only because I pay the bills in the company.
Right, yeah.
Right. Probably others my engineers use and I don't even know about, but very interesting. So you're on Fund 3 now, so you've been doing this for a while. What's the trend? What's happening now? Obviously AI, we're going to get to that question. How's AI changing all this? But maybe give us any broad strokes of how this industry is kind of changing and evolving.
Yeah. Well, certainly that's a huge part. We can come back to that. I think maybe more subtle changes. We're now, I guess, pushing 18 to 22 months into like a interest rate reset environment. And so I think there were a number of years there where there were a lot of organizations, if money's free and you can hire as much headcount as you want, like you start to get less concerned as the business person about like, oh, hey, how many developers do you need? And now we're in an environment where I think, again, IT budgets went through a constriction last year for the first time in probably 15 years, right? Since the great financial crash. And so that's an interesting time where you reset and you find out like what products are must-haves and what products are nice-to-haves or actually features and not products. And, that's still shaking out. I think we're getting much more clarity. I think every business had the kind of companies we invest in, everyone had a tough year last year, but now this year we're seeing the really foundational good companies and products are heading back in the right direction. And the other ones, it's become clear that, it's not, it's not their time or not the right spot. So that's an interesting trend of like productivity matters again, efficiency matters again. And so all of that speaks to doing more with fewer people and spending money to achieve that in terms of buying the products you need to do that. Another trend, which is really fascinating, we have a number of investments. For years, certainly like the past decade, as digital transformation was going across the enterprise, a pretty tried and true way to select investments was go look at whatever the trendiest, hottest Series B, C startups were and what tools they were using. And then you could just extrapolate out and say, oh, okay, those are what the enterprises will be buying. And certainly if I look at Circle CI and PagerDuty and a number of the ones we just talked about, they absolutely follow that path. I think it's fascinating now that enterprises are really fully digitally transformed and in a sense, cloud native. There's a whole set of problems those enterprises have, challenges and pains in that environment that a Series B or C startup with 20, 30, 40 super senior engineers does not have. In our, like I mentioned, LocalStack earlier, which is solving like reducing the need for fresh green developers to get access to your cloud account, or reducing the cost of testing. Causley is another company of ours that's helping with governance and compliance in the continuous delivery process for like regulated industries. And these are problems that big enterprises have in spades that startups can, basically it's a problem startups can aspire to have at some point in the future. But now we're in a place where you can actually take a startup and go selling directly to that need, which I think is interesting. Then I guess if we're rounding it out with like a trilogy or a three-part, AI is just we're in the earliest innings of understanding. We have these transformers. We're barely 2 years in, but obviously are just really, really good at manipulating discrete sets of text, and ultimately software running code is a discrete set of text. And I think we're already seeing like big returns in certain ways of software engineering teams applying this to test generation, to code generation, documentation. And so we're very interested in that too. That's, I've said in some, the only thing I'm certain about in, the future of software engineering is that humans are still involved, which I think interestingly enough is still an open question for a lot of people these days. But I think how they do it, even how humans interact with computers, I think it's just going to look really different. I think that's what's kind of interesting. Right now we have these prompts where we're putting English language, but I think like we're going to have to fundamentally rethink some of the human computer interfaces that we've had going all the way back to, Spark Labs, right? And the mother of all demos. So yeah, that's kind of trend. There's some big meaty trends.
Yeah, no, definitely. So go indulge me for a second. So let's fast forward 5 years, or maybe even 3 years, 2 years. What is it maybe an extreme potential scenario of how code is written and delivered with, pretty widespread AI? Like, what could it look like? I'm sure you've kind of given a thought to what this could look like a few years out. Paint us a picture. What do you think?
Yeah, well, I think for starters, it's helpful to kind of divide when you talk about code in general, kind of divide code into a few different buckets, right? And so there is, first and foremost, to me, what's most important is the code where, whether it's a new software product or like a large kind of initiative within an enterprise, I'm thinking of like, your e-commerce operation or whatever. So like a line of business, that's a better way to put it. Sorry, like line of business software where today you have hundreds, if not thousands of engineers collaborating to deliver this line of business software, which drives large profits for the business. I think that is something where actually the actual code being written is a very, very small part of that process. And so in high performance computing, we have this thing called Amdahl's law, which speaks to like if you have a process where some of it can be sped up, but some of it can't, then on a long enough time horizon, what it'll take to do that is going to be dominated by the piece that can't be sped up, right? Because the thing that can be sped up will be taken to zero. So if like rote code generation even goes all the way to zero, then I think it's instructed to look at, okay, well, for this process, how much of it is actually just rote code creation? So for those sophisticated large scale systems, I'd argue, and I was at a kind of a birds of a feather thing discussing this about 6 months ago with some very kind of serious technologists, and we were talking about this, and I stopped the conversation, just said, hey, everyone who's been like a principal level or distinguished engineer level, like very serious software engineer, like raise your hand. And then I was like, okay, of everyone there, how many of you in that role spent more than like 15% of your time hands on keyboard typing code? And like every hand went down, right? Because like at scale, the really serious parts of software engineering are not typing code. It's like figuring out what the software even needs to do, figure out how it scales, figure out how all the pieces interact. So that's one bucket. The next bucket, there is, however, a bucket of like, hey, we just have a very repetitive thing we need to do. Like I don't know how many yoga studios or real estate agencies or whatever there are in North America. Every one of them needs a website, a marketing site, probably, some way they can like take payments or schedule appointments. And there's like nothing unique about that except like the images. Honestly, even the words aren't that unique, or the images, right? Like, and so there's a very thriving, I think, set right now of businesses that, create those websites, manage them, service them. I feel like that's going pretty, that can be almost completely replaced. And so I think at first it's helpful to look through the lens of like, okay, what does your business serve? What kind of customers, and how much of it's writing code? So to your point, fast forward, things I think will happen when you're actually writing code, just the going from, the point where the engineer goes, oh, I know this is what the code needs to do now, which there's just so much work that goes into getting to that point. But once I get to that point, I think we're already seeing, like, you can say, hey, what I need is to, like, I need a function or a thing that like iterates through these resources and performs this operation on each of them. And once you describe that to the model, particularly if you've given it the appropriate context, like it's very good at just spitting that out. I think code review in terms of like, hey, help me review this code for security defects, for functional defects. I think that's going to be augmented. Test generation. I think testing is going to be significantly automated by these things. Yeah. And the other, sorry, we could go all day on this.
Yeah, keep going. No, it's good. All good.
Yeah. Another lens to view it, I think these technologies are going to give senior engineers superpowers. So I do think that's a critical, at least today, very critical. And I think it's intrinsic to the nature of the transformer model, generative AI, is having a human in the loop who can interpret the output and adjust. And this is where, for senior engineers today, they've been doing this their whole career because they've been looking at the output of a junior engineer's work and saying, oh, hey, this is good, but this needs to change. I've seen Simon Williamson, I think I saw in another interview, referred to generative AIs as a weird intern. And weird because it works 24/7, and you actually have to be kind of rude to it and keep telling it repeatedly like what it's doing wrong. But if you have that mindset, now as a senior engineer, you can have an army of junior engineers or interns working for you effectively, and following without any of the people management problems, right? The other thing I think it's going to be really, really good at is helping junior engineers become senior engineers, in terms that, like, I don't know if you're familiar or heard of Stack Overflow, the website, but that was when that came out, and that's almost 20 years ago. It was a real phase shift in learning new things about technology, or junior engineers becoming more senior, because suddenly there was this place you could just, if you couldn't find the answer, you could post a question and get an answer pretty quickly. Whereas prior to that, you had to be digging around, old websites or reading books, which I like reading books. I don't know that many people do anymore. But when I started programming, I had a whole bookshelf, many from O'Reilly, but like from other people, where I would have to go and like look through a paper book, right, to find the answer to my question. So Stack Overflow is this huge leap forward in speeding up people's ability to learn what they needed and go. And these models for those people it's just another order of magnitude or more leap forward, right? Because you literally just say, this is what I need, and it spits it out. And then you can ask questions about it, like, hey, I don't understand. Why is it like this? And it spits it out. So compressing that learning and maturation cycle, I think, will be really important.
Would you go into code? Would you become a developer these days? It's a little bit of a tangent question, but like,
I think it's a great question. And it's funny how many times in my career that question's come up, right? But yeah, I would still become a developer. Like, the reason I originally became a developer 25 years ago almost now is because I just love the process of having an idea in my head and being able to make that concrete, like, immediately, right? Like, if I was like, oh, I think a thing could work like this, and I could write some code and I could run it and I could see, and I'm sure there's some like dopamine reward cycle at play there. But for me, it was a combination of that. And also, for whatever, I do think there is a certain, I don't know, left brain, right brain distribution where certain personalities or types tend to be attracted to like the work of like keeping all the logic in your head and then getting it onto the screen and debugging. So I think if you come at it from that way, I would still 100% recommend it, because I think, like, for people who really commit to the art and craft of building software and just really love it, it's still going to be a very rewarding career. It's going to look a lot different than it did, 5 years ago, let alone when I started. But I do think still fundamentally there will be an art and craft, and for experienced people, there's going to be a spot. What I think is going away, and I do think we're in a situation now, is a bunch of people who are like, hey, I could be a lawyer or a doctor or a programmer. Of those, I think programming is probably the easiest way to make the most money with the cushiest job, so I'm going to do that. That's been a very viable career path for 20 years. I think that one's going to be tough, because I think the kind of work those people ended up doing is the kind of work that's mostly going to go away. And I think you're just really going to have to commit. Like, I do think for a while it's been enough to be like, hey, I learned a couple of programming frameworks and I'm totally fine with just cranking away on doing repetitive work because it pays super well, which it has. But it's another level to say, well, even you can see right now, like, the people who are throwing themselves into these new technologies, and it's the same with cloud computing. It's like the people who just love living at the frontier and throwing themselves into whatever's next, and figuring out how to use it, they're going to, I think, continue to do very, very well. I just think you should be just really honest with yourself about what your motivations are. If they're purely financial, which has been sufficient for a while, I would reconsider.
Yeah, interesting. Very cool. Let's shift gears a little bit. So you work with lots of startups. You've invested in lots of startups. How many companies in your portfolio nowadays?
Oh man, I have to check the exact number. I think it's around 80 right now in the portfolio.
Yeah. So what advice do you share with your portfolio companies on raising their next round? I assume they're mostly coming to you when they're raising seed. You guys are pretty early stage. So then they're moving on. give us some advice, some tips that you share for, developer first startups raising their next round.
Yeah. Well, there's a lot. We're very hands-on with our portfolio founders. In part because almost all the partners here are ex-operators, have raised money for our own companies, have been in the arena, so to speak, right? And so I think we can kind of deeply emphasize with those founders and the struggle, and not just the choices, but the trade-offs you make when you raise money. So like first and foremost, the most important thing I tell people is there are only two reasons to raise money. The first reason, which is the good reason, is that the single remaining bottleneck on accelerating your business is capital, access to more capital, right? So at the stage you're at, you figured everything out, you know what you need to do to accelerate the business, and it purely requires cash. That is the single best reason. That is the only good reason to raise money. Let me engage in a little hyperbole. The second reason to raise money, which is a bad reason, but it's still a reason, is because you're going to run out of money, right? Mm-hmm. And it could be that we're going to run out of money, but we had some missteps. We know what we need to do now, but we're not there yet. But whatever. So that's important framing, because a reason you should never raise money is someone showed up and wants to give it to me, and that is I call it out because many fundraisers happen explicitly for that reason, right? And that's just the nature of the venture capital industry. So first is like understand why you're raising, and if it's one of those two reasons, and then get yourself in the correct posture, right? If you need the next thing is then like you have to tell we'll just work with the hey, it's the right time to raise money. So you have to tell like a very crisp story, right? Like I think for instance, like decks get a bad rap just because PowerPoint atrocities, and I'm sure there's like websites that can pull these all up. But it's really, really important that you take and we have a blog post about this. I could put, if you have show links, I could get that for you. Mm-hmm. But you have to take the investors you're pitching on like a step-by-step journey. And like at each point when you're pitching, and at each point in the pitch, you have to understand like, okay, there's like a series of things they need to believe in order that get increasingly fine-grained, that lead to you successfully, I don't want to say convinced, but like just like making it clear to them, right? Because they hear so many pitches in the world now, and in many ways, like the world is so fractured. If you're doing something unique today, like by definition, it's very complex, very sophisticated, a lot of nuance. So you kind of have to distill that down. It's like, for me, it's first and foremost, like, can you communicate like what is the pain that you're solving? Because it all comes back to like, doesn't matter how good your tech is, like it doesn't matter how good the team is like, what is the pain that you're solving, and why is it really valuable for people to solve it? And as an investor, I have to believe that. If I don't believe that, then nothing else matters. And then you go from there. Okay, once I believe there's a pain, well then convince me in the abstract, what is the right solution to that pain, right? And so like, just tell me like, okay, well this is, and this gets tricky because often there are existing attempts to solve that pain, but like what you're pitching is, look, these are inferior or not sufficient in these ways. The actual precise solution, which no one has realized until me, is this. And then if I believe that, where I'm like, oh, hey, that's brilliant, that's actually the right way to do this, then it's like, okay, great. Let me show you our product, which solves this pain in this manner of solution. And then, if I buy I'm like, oh, okay, this product is a great execution. You built the right product. Then we can start getting into, well, what's the go-to-market, right? Like because it's not just enough. You can't just build it and they'll come. You have to after product market fit, you got to find go-to-market fit. And so it's like, I think it's really critical. There's just so many calls I get on, and an entrepreneur, look, even at the earliest stage, even if you're like and many of the people some of the people who pitch us are pre-company, right? They're like talking about like, hey, I want to incorporate a company to do this. If I incorporated that company, would you back us? And we're happy to engage and invest at that stage. But there's still a version of that, right? And so I when I get on and, some founders are just, it's on a call like this and they're just like, oh, we'll just talk about it. And just as, I think I do a decent job of pulling this out because I know the narrative I want to understand. But I think, for a lot of investors, you're doing yourself a disservice if you haven't really done the work on that narrative and why your company, why now, all those things. Other, piece of advice is, you want to raise enough with a buffer, and not too much. I think, I think for people who aren't, students of the venture capital industry, or paying close attention may not realize like kind of what a weird. I guess in hindsight, one thing, because I pitched my first venture round in 2004, so I've been involved in some side of this for 20 years now. And the thing that's fascinated me is just how quickly the venture ecosystem has evolved, right? If you think of like, 2004, there was a couple hundred firms all in San Francisco, all generalist, a couple big brands. The standard deviation on fund size was not huge. Now fast forward, we've got thousands of early stage funds. They're all over the world. You have mega billion-dollar funds. You have tiny solo GPs. And so it's constantly evolving. And so I think as a founder, and this is where we can help, or your investors should be able to help, is understand what is the macro environment you're pitching in, because that really matters as to like how you pitch, what you can expect. I often have founders come in, they're like, oh, well, I think I should do this because my friends raised this, did this 2 years ago. And they have like 2 or 3 data points that are completely stale. And I have to be like, okay, yes, that was a thing that could happen then, but it's not now. I mean, our latest example is 2 things. The interest rate, I mentioned earlier, we're a dramatically different environment than we were in 2021. And you have these mega funds who the smallest check they can write is still pretty big. And this is all context, I guess, for know the right check size for you. Don't let a premium logo talk you into raising too much money. Because I think it's as counterintuitive as it may seem, I think for a startup, too much money is even worse than too little money. Because too little money, you can adjust and kind of keep going and get to the right amount. Overcapitalization is I think if we're being honest with ourselves, a silent killer of a lot of what otherwise would have been great companies.
Interesting. I imagine most or many of your portfolio companies are led by software engineers, right? Probably scratching their edge. How do you get them coached up to be able to pitch? Because those I'm stereotyping here, but those guys aren't often the best pitchers. Yeah.
Look, I like I said, I think stereotypes and hyperbole can be helpful in a conversation like this. Look, I often, like when I'm talking to our LPs, like our investors in the fund, the way I position it usually is, our prototypical founder is usually a brilliant technologist or quote unquote at worst like product person, right? And they have this like clear, crisp view of some new category that has to exist or some existing category that has to be redefined, but they understand a future that is better for their end users. And mostly in part because they have lived that pain themselves and they have a really innovative way to solve it. That being said, their like commercial instincts tend to like, I say not only be wrong, but like actively harmful. And so Heavybit, we've always taken like a very kind of educational approach to this process where first and foremost, like I said, they are brilliant. They are going to own all the successes of their companies. They're the only ones who can succeed. This is not like we can't come in and do it for them. But what we can do, and we view ourselves as in this role of like coach, mentor, educator, like these are the practices, these are the way to think about these things, like this, to think about your go-to-market, to think about pitching. And we do a lot of work even just with like simulated dry runs on the pitches, because both there's like understanding how to pitch, and then to your point, like these kind of founders can be, have varying degrees of charisma or comfort with public speaking. And so, we help there. That being said, I think there's a small amount, like if you're going to be the CEO and particularly the CEO, you have to be comfortable with pitching and talking, and you have to find your voice. Usually that person is inside there, and what we're just helping them do is get that person out, right? And just realize that, just because there's been this stereotype or they haven't done that in the past, like they can. That is definitely an area we work with a lot on founders, that, there are maybe funds that specialize in, I don't know, gaming or something else that don't have quite the same problem or challenge rather.
Yeah. Interesting. All right. Well, we're almost out of time, but what you've raised, you're going on 3 funds now. How is it different raising a venture fund from raising as a startup, and maybe give a little story or two from raising the funds? You've got something?
It is both similar and very, very different. And so, I think a similar thing is that for most managers, just like for most startup founders, like, look, there's always the stories of like, oh, I raised, in one pitch meeting on 10 slides, which is a common LinkedIn post, or, which I I always as a founder would annoy me because I'm like for most of us, this is a grind and we got to talk to a lot of people and it's a pretty contrarian event. I think those are like there are consensus deals that happen are very competitive. But for most founders, that's not the case. And I think the same is for funds, right? Like, if you're, Sequoia or Kleiner, whoever, like, you probably don't sweat raising your next fund. For most of us out here on our, first, second, third funds, whatever, like, we're still proving ourselves ultimately because it takes, venture is like a 10-year feedback cycle or something wild like that. So it takes a lot of time. I guess that's one difference from, as a company, I could go out and blow out, a couple quarters and suddenly I'm a different product. As a venture firm, like that takes some time. I think the other thing, I mean, right now, going back to like understanding the macro, we're at a moment right now where it's funny. We raised our first fund, which was challenging because it was a first fund. I think any first fund is a challenging raise. We raised our second fund in 2020, right in the teeth of the pandemic, and having to pitch LPs over Zoom who had never been pitched over Zoom. And now we've had this like interest rate environment shift, and a lot of LPs are feeling a liquidity crunch, for the first time in over a decade, where they, there's a lot of people don't realize like the LPs that back us, and this is what's different. Like if you're a startup founder raising from a VC, like for me, I have a pot of money and I got one job, and that's to put it into startup founders, right? And I'm on a clock to do that too, right? Like 2 to 3 years to get this fund in the ground. And so you're going to find very willing buyers for your product. When we're pitching LPs, these, if you're talking like charitable institutions, educational endowments, these are people who take a 20-year time horizon on their investments. They invest in a huge variety. One of my favorite anecdotes is like these LPs love investing in timber farms because if the price of wood goes down, you just leave it in the ground, it gets bigger, and when the price comes up, you have more wood to sell, right? But as long as you have a 20-year time horizon, it's a great investment. And so like we're competing with, it's like, no, the venture is right for you to allocate more dollars to away from timber farms or public equities or late stage private equity, and so I think, the liquidity crunch, and when their existing venture, because the IPO window is still shut, because M&A is like, lower than it's been in decades, they have a illiquid chunk of venture on their books. And until some of that starts to come back in, it gets very hard for some of them to make new bets. And I think also like a lot of things in the last mania in 21, 22, I think there were a lot of funds raised that probably shouldn't have been raised. I think LPs weren't applying, much like venture capitalists weren't applying, and founders went like all the way down, right? No one was applying like the kind of level of scrutiny and discipline that they should have been. And so we're also working through where there are tons and tons of managers in market right now, and a lot of them are not going to raise their next fund, but that's just causing like noise in the system. It's an interesting time. I guess the last thing I'd say, which is kind of much more tactical, a slow VC these days probably takes a few weeks to a month or so to make an investment decision. Institutional LPs, you're like, if you can get someone from a first meeting to, closing into your fund in 6 to 9 months, you're like crushing it. I mean, a lot of them you meet and they're like, oh, this is great, so let's talk about your next fund cycle. So like the sales cycle length is just dramatically longer raising venture. But we also,
no, for sure. That's interesting. Very good. All right, in about a minute or so left, what if anyone is a startup building a developer focused startup, or a founder building a developer focused startup, how should they get in touch with you? Are you a warm intro guy? Are you a cold email? Do you have an application form? Is it find you on GitHub, or what's the best way to get plugged in?
Yeah, no, I mean, I those all honestly work. We do have an application on our website. My favorite, I think for obvious reasons, is a warm intro. That's always great because that's just it's someone else that can kind of work with on your on your thesis. But yeah, you can email me. I mean, I've invested out of all of those. I've invested on tons of warm intros. I've had some great cold emails that I've ultimately ended up doing an investment with. Applications to our site we've done investments out of. So yeah, I try to be very open-minded. I will say, maybe pertinent to the AI thing, I've just been thinking more and more, at least for me, the bar for a cold email has gone way up. in so much that it's clear there's a lot of founders out there now. I mean, I can go in my inbox and pretty much pinpoint the date, going back, whether it's, 16, 18 months ago, who just, turn up one of these SDR style bots and put a list of investors into it. And it does the thing where it's like, oh, hello, I see that you insert blank developer tools and you insert blank this. I just delete those. So like if your email doesn't make it clear that you understand what my firm does and why we would be a good fit for you, like I'm not going to respond. I used to some of those because they were human written, but that's just not a thing I can do anymore.
Yeah. It's we're probably a little bit guilty of that. We added a ChatGPT integration to our email tool, and honestly, the results that GPT are writing, it's just so obvious. I don't know. I guess this is the early days of this. Maybe that'll change.
It'll get better, and I think it will work. But for me, I think it depends what you're selling. I think for companies who are like, hey, this is clearly a pain you have, and here's a ChatGPT thing that explains how it solves your pain. That's going to get you demos. Like I think that's smart to do. Getting an investment for your company is such a bespoke process. Ultimately, using ChatGPT to research firms, using ChatGPT to help you narrow down the firms that you want to talk to, I think that's all great stuff. Having it mail investors, I think, is a terrible, terrible mistake for an entrepreneur to make. Like stuff below the waterline, have the robots do the stuff below the waterline, but like that, tip of the iceberg, whatever you want to call it, you should still do that.
Absolutely. Well, but in our defense, I mean, the thought process is it would help research your background, what you've done, and pull that all together for the founder so they can create a good email. But a lot of people
totally, that makes a ton of sense.
Verbatim. Yeah. Very good. All right. If people want to learn more, heavybit.com, I believe, right?
Yep, right? Heavybit.com. And if you're listening to this podcast, you want to just shoot me an email, I'm just joe@heavybit.com.
Cool. Good stuff. All right. Well, thank you very much. Congratulations. Keep up the good work. I'm sure we'll be spending our money on more of your portfolio company's products before long. So
one thing I'm certain of.
Yeah. All right. Thanks, Joe. Appreciate it.
Yeah, it's fun. Thanks so much for having me on.
Over now. Bye.